Good evening and warm welcome to all our esteemed viewers from for the 31st edition of Cedrus Knowledge Series. We initiated this series during pandemic with a core objective to invite distinguished speakers each month to share their experience on diverse topic, not limited to finance but also health and personal well-being. Now, let's proceed with a short video presentation from Cedrus Wealth Partners. Today, we are honored to have with us Dr. C.K. Narayan, the Managing Director at Growth Avenues Asset Advisor Private Limited, founder of NetroTrade and author of Traders. Sir, it is indeed a privilege to have you with us to discuss your valuable insight on technical and fundamental analysis. We will now play a short video to further introduce our speaker. Welcome, Dr. Narayan. I want to remind our viewers that this is a moderated session and we encourage you to share your questions in the comment section. Towards the end of the discussion, we will address those questions and provide thorough answers. Without further ado, I would invite Mr. Nilesh Bajaj to guide the discussion forward.
Thank you, Angel, for the wonderful description and introduction of Dr. Narayan. Welcome, sir, and welcome
Thank
to
you for
all
having
our.
me here.
It's our honor, sir. It's an honor to have you. For our viewers, I just want to give you some, apart from the introduction which we gave, okay. Dr. Narayan actually is a dentist by profession, by qualification, sorry. Okay. So he's a doctor, and a dentist. So, my first question which just came up was, how come that's very personal, nothing to do with technical or fundamental analysis, is that how come, you took your formal education in dentistry and you got into this, this field of technical analysis, in fact?
Well, I think, I became a dentist by accident. I must have always had this kind of temperament towards analysis. So, back in those days when you were graduating, either you went in for engineering or you went in for medicine. There really wasn't a alternative career. Only these two pathways were there, and I was not cut out to be an engineer, so the only other choice was going into the medical side. So then I went into dentistry. I finished dentistry. I passed it with honors, etc. But I always had this analytical bent of mind, and during the time that I was a student doing my dentistry, I came across the stock market way back in 1976, 1977, and right from I think day one, the market got its hooks into me, and from there has been no looking back. So
Wonderful.
then I'm kind of completely self-taught in fundamentals, completely self-taught in technicals, because during those time there was no classes, no programs, no trainers, there was no formal way to learn anything. So just got hold of books and read it up, did all the work, and so probably the learning curve that time was much longer than what it is today, because you got so much of material and facilities which are available. So it just happened out of interest, I would think, in having an analytical bent of mind.
Wonderful. So you were you did dentistry by chance and technical analysis by choice.
Yep, you could definitely say that. I was
Wonderful.
actually I was actually a fundamental analyst by choice at the start, because there wasn't anything about technical analysis when I looked around at that point of time. This I'm talking 1976, 1977. And that time I taught myself how to do fundamental analysis, read a whole lot of books on it and all that. And I persisted with that for about 4 years. And somehow it didn't work to the kind of exactitude that I desired in my own work. And somewhere around 1981, I think I came across some tomes on technical analysis. And when I read that, then I thought I found my calling there. And that's a kind of, the bent of mind that I had. And therefore, I went into it wholeheartedly. And from about 81, 82, you could say I've been a technical analyst all through till today.
Wonderful. So you have actually been fundamental analyst and later on as a technical analyst, and in
Yeah,
fact, our topic itself is fundamental and technical analysis. Are they substitutes or complements? In fact,
absolutely.
are
I
they
agree.
substituting each other or are they complementary? Because we do here, and the markets are booming, so I'm sure there will be a lot of new traders which will come out, and they will call themselves technical analysts in the boom market. Uh,
True.
but maybe there is a complementary aspect which we feel and which we are not very clear, because like what you mentioned, I am actually we only do fundamental analysis, but definitely we feel that there is a technical aspect attached even in a fundamental analysis, which we are seeking answers from you. So actually my first question to you is uh, that do technical and fundamental analysis differ? Okay, do they differ? And or they are complementing each other? And how does it help in decision making, whether in trading or in investing? Okay, so that's my first question to you.
Yeah. So I've actually made a small presentation which I will make. I think which should kind of answer most of the things that you have asked, because I've designed it along those lines. So many times when you have two things, right, and you're kind of asking whether one should look at this or one should look at that, most of the time the answer will point towards any one of the two. But here, as far as fundamental and technical analysis is concerned, I think we have kind of a little rare combination where the answer is that it could be both, right? So, as a part of the presentation, I'll briefly explain as to how one could, make it complementary, as well as where one should use one as a substitute for the other, right? So, without much further ado, let me go into the presentation, as it were. And what I'm going to do there is, first of all, put up, certain salient facts about the fundamental and technical analysis, which is what I'm saying, FA and TA. Now, the general perception or general understanding of fundamental analysis is that it is meant for the long term, whereas technical analysis is meant for the short term. Now, this is how it is understood and this is how it is practiced, but very few people really fail to ask as to why this is, should be uh, a question at all. Why is it being thought of like this? So the thing is, what I'm saying is, the data related to fundamental analysis, right? That is available and change through longer periods of time. See, you have quarterly results, you have annual results which is audited, and you have publications which come out over a period of time, right? So you will have, there is a difference in the way that you have the data coming up, right? So fundamental analysis data is available through longer periods of time. Therefore, fundamental analysis is applicable only for a longer period of this analysis only. In contrast to this, the data related to technical analysis, they are available and change through shorter periods, right? And therefore, the technical analysis data enables you to analyze the shorter period. This is the basic, the basic, or let's say even the fundamental difference between the two. The difference lies in the data set that you analyze, and because these two are quite different in the way that they reach the analyst, I think they are forced to adopt a uh, certain kind of time frame for making the analysis. So when you have slow moving data, slow arriving data, slow changing data, naturally you won't be able to use that data set to analyze the short term. Whereas when you have price and volume, which are the two data sets for technical analysis, they are available on a minute to minute, second to second basis. So there is copious amount of data which comes in very swiftly all through the day, every single day, and all through the year. So there is a lot of data which you can slice into different time frames, and that is what enables you to do technical analysis over shorter time frame. And that is why we have this basic difference. Now, the advantage here is that since technical analysis, the data is already available and you can construct or view it through different time slices, it is possible to do long term analysis also using technical analysis. This is the thing which is not really understood, and it is not really practiced by many people because the demand as such is for the shorter term, which is not possible through fundamental analysis. So that said, and the basic difference, or the basic the struts on which these two analyses stand, that has been cleared. Now let's move into the complementary aspect of it. Now, how do these two things become kind of complementary? So let us go and see that part. And let's see here. What I've said here is that, what do both these forms of analysis do? Now, neither of them tell you. Now, this might come as a bit of a surprise, but neither of them are going to tell you whether you will make money with the stock that you buy or sell. Now, this might seem very contrarian or paradoxical or even ironical, because analysis is supposed to tell you this, right? But then fundamental analysis throws up the best candidate within a list that you can invest in. It says nothing about whether that stock will make money. It just says that if you want to invest into, let's say, the IT pack, then you can analyze the entire IT pack and say either TCS or Infosys or something. That's the best stock to invest into. If you ask the second question, will I make money in Infosys or TCS? The analyst cannot give you a fair and just answer, because he will say, I do not know, but this is the best stock to invest. Similarly, a technical analyst can only tell you that this is the best time to buy the stock or sell the stock. That is about the only thing technical analysis will actually tell you. So if you ask a technical analyst, will I make money with this buy or will I make money with this sell? The answer, truthful answer, will be I have no idea whether you'll make money. But if you want to trade right now, then this is the best stock to buy and this is the best stock to sell. So this is the way it is actually is. But then most of us understand it differently. That is our fault, right? And that has been the practice, that anything that a technical analyst recommends should work in the shorter term, and anything that a fundamental analyst sort of recommends should work over the long term. But neither of these are part of the analytical fronts. So what we need to do is combine the two to give us both the information of what is the the best stock to buy and what is the best time to buy it, or what is the best stock to sell right now and what is the best time to sell it, right? And matters work best when fundamental analysis and technical analysis combine to produce a trended action in the market. Now this is the key. You make money in the market, irrespective of your form of analysis, only when the market trends. And the market tends to trend for various lengths of time, right? And that is what gives rise to various trend definitions of short term, medium term, long term, etc. And you have bull phases, bear phases. When you string them all together, you have bull markets and you have bear markets. And then people have done all this research and say that on an average a bull market will last about 3 4 years, and on an average a bear market will last between 2 to 2.5 years. This is based upon history and it's a empirical kind of data or the observation. So bull markets have been known to last longer, and so have bear markets also. So it's just a broad definition, but the key thing here is whether we have a trend, because only in a trend can you really make money, either buying the stock or selling it short. When the market does not trend, it is very difficult to make money. So when fundamental and technical analysis combine to produce a trended action in the market, this is when big gains are made. And if you look at the Pareto principle, right, that works in the market also, that works in investing and trading also. What does it say? That 80% of your money comes from 20% of your trades or investments. This is true for everybody. Now, you may have a portfolio of, let's say, 10 stocks or 20 stocks, but your real fortune is getting made from only some 20% of those names. They are the big winners that bring you the money. The rest of them are either idlers or also rans, right? So it's the same here also. So we need to know which is the best period when big gains can be made. And big gains are made when FA and TA come together. So there is another aspect also that, so this is the complementary part that one should take note of, that if you want to really make the big money in the markets, then you must find out when fundamentals and technicals are joined together. I'll show you an example of that later on in the presentation. The second important point that one should bear in mind, whether one is an investor or a trader, is that fundamental analysis and technical analysis will be at complete divergence or at a very wide divergence at market extremes. So when the market is extremely bullish, the fundamentals look to be extremely good. The sky is very blue. But you must remember and understand that bear market sets in from the bluest of the blue skies. And when you are in the depths of despair, like you were back in 2020 March, that is when the seeds of a reversal and a new bull markets are sown. So at the bottoms and at the tops, you will have great deal of variance between technicals and fundamentals. And this is a vital point for us to understand, identify, and even forecast when big long-term changes are about to happen. And an analyst is only as good as a the length of the forecast that he can make through time, because money is made through time, right? And therefore, if you have a good forecast which works out well through time, then you will be deemed to be a good analyst, and you will have the fruits to show for it. So FA and TA diverge from one another at market extremes, and this can also be helpful for increasing the efficiency of the process, right? So you can work both of them a lot more efficiently when you are able to spot this divergence. And then going on, FA and TA actually support one another. You can go as far as saying that they are two sides of the same coin, right? So on one side you got fundamental analysis, and the other side you got technical analysis. And if you look at it from a different angle using a similar analogy, you could also say that fundamental analysis creates a cause which creates a movement, and the movement is what is studied by technical analysis. So you cannot have a movement without a cause, right? And if there is a cause, a movement will certainly occur, because based on the cause, people will act or react, and that will produce a series of actions, and that actions will have an outcome or a result. And that is why fundamental and technical analysis, when you study them in a complementary manner and use them in a complementary manner, you will actually be able to see how effectively they work together, and much greater returns can be extracted if you were to make this combination. Now, one more point here which I want to add is that with technical analysis, you can also add a risk control element to your approach. Now, the problem with fundamental analysis is that it lacks in the area of risk control, active risk control. See, as soon as you have a position on in the market, whether it is an investment or a trade, the risk meter is on, right? You do not know what will happen tomorrow, next week, next year. It is all our conjecture, or we envisage the future to unfold in a certain manner. It may not. So technical analysis is something which will allow you to set the risk parameters alongside, and that is what will help you fix up what is the risk element which cannot be done by fundamental analysis. So moving on, if we go to the next chart, now I want to take you to a chart where I want to show you this point which I made, because I think that's uh, a major point which needs to be understood very clearly. I said FA and TA diverge at market extremes. So here I have a long-term chart of the Nifty from 1997 all the way till 2023. So I leave the first part of it alone, and let's take this big run which we had in the market 2003 to 2007-8. Oops, it went back. So let me just put the uh, so it if you see this area of the chart right in the middle, right? So that area is 2003 to 2008, and in that area you had this very very strong advance, and everything was looking fantastic. Like, if people who are part of this webinar have been part of the market back in 2005, 6, 7, you will know what I mean. But as 2007 was ending, somewhere around December of 2007, right, you had very very clear evidences on the chart that this is not going to persist for too long. And I have been writing newsletters for a long time, way back from 1991. I've been writing newsletters, and my December newsletter of 2007 says exit the market completely, right? And I also followed that to a T, and I exited from all my stocks by about the third week of December. The market ran on a little further for a couple of weeks more, and on 7th of January 2008 is when it broke. And then it broke in such a severe manner that we all thought Armageddon was upon us. And it was indeed a big financial reset. And that is the time when you had bank failures and Lehman Brothers and Bear Stearns and all of these people going bust. And everything seemed to be completely out of whack. And then that continued on for almost a year. Sometime around March of 2009, it again showed that the technicals were way out of whack with what the fundamentals were indicating. Because still about Jan, Feb, March of 2009, the situation was extremely bleak. And it looked like all these problems which were there in the US, they were talking about quantitative easing, printing of more money. There was talk about hyperinflation, and all these things were kind of bedeviling the market at that point of time. But 2009 and the technical said things will turn around. And then from there, it turned around and it kept running and it kept running somewhere around here. And then we come to the later stages where we had let me cut to the chase and come to 2020, right? We had a nice strong market which went up from about 2013 August all the way up to around 2018-19. And if you looked at that, and this COVID thing came out of the blue, nobody was prepared for it all across the world, and suddenly everybody was talking about 100-year-old Spanish flu and how that killed millions of people, and we were seeing all that, and then everything went down the tube. March 2020, we fell from 21,000 to somewhere around 7,500, which was like a huge fall, right? And that took everybody to cleaners, and again the situation was extremely bleak. Now I have shown some indicators here which this is not the forum for me to explain, but there was a setup back in March 2020 which told us that this decline is not going to last, and that the technicals were giving us a clear signal that the market was possibly trading at a bottom. Perhaps it will not tell you that you had such a glorious rise which came out of the 2020 bottom, but it certainly told you that this was not the time to panic. Now, lots of people redeemed their mutual funds at that time. They redeemed their PMS at that time. Everybody quit the market at that time. All these things happened, and those people ruled their decisions perhaps even till today. So this is what I was meaning, that at major market tops and bottom, there'll be a big divergence. Now, to spot this, you will have to learn and understand technical analysis well. So that is the caveat which goes with it. Now let's cut to the chase further and come up to where we are today, right? Today we are having a hint of a pattern on the charts, and there are some associated indications with the momentum, etc., which is also telling us to be a little bit careful. Now we are having the best of the news right now. There's ample fund flow from the FIs. There's so much of block deals. Everything is going down very, very smoothly, right? And people are coming back, and SIP is going on, and inflation seems to be under control, whether it is in India or whether it is in the US, etc. And everything looks hunky dory, and people are probably wanting to come back to the market. There is this huge FOMO feeling, right? But there is some amount of small signals which are being emitted right now. Now, if these signals were to grow in more meaningfully and kind of manifest on the charts, then technical analysts should start taking note of them and then try to plan their future in advance. We may have more to say if time permits ahead. So this is what I wanted to say about a very important point, that FA and TA will diverge, and therefore that is one primary reason to make fundamentals and technicals a complementary approach. Moving on, let us go over to the next slide, as it were. And I need to click. Okay, so another major problem when you are trying to do fundamental analysis is that you come across a lot of stocks which are value traps, right? Maybe which is the chart you have on? Okay, I have gone one chart ahead. Okay, this is the one. Big moves when fundamental and technical analysis come together. This is the other point that I had made as to why we should use them in a complementary manner. So I've taken an example of the specialty chemical sector, which just boomed. like nobody's business from about 2013 to 2020 or 2018-19, where when it started to falter. Why did this happen? Everybody knows the reason. China shut down its plants because of control on pollution, etc. And India was also one of the big manufacturers. Everybody ramped up. India became the go-to place for any kind of chemicals, because people here were not unduly bothered about whatever pollution, etc., was happening. And that is what happened. China started to shut down somewhere at the start of 2013. And I put down here three major stocks. First is uh, I think Aarti Industries. Yes, the second one is Vinati Organics, and the third one is SRF. Now these are all big players in the chemical space. I've just taken them randomly as three examples. Now the vertical line shows you that all of them turned around in their towards their upward cycle from around 2013 levels. And that is when this news about China shutdown started to come in, and people started seeing possibilities here. And then it just kept running, because as the demand came in, the prices rose, everybody started making money hand over fist. Every company, whether in dye stuff or specialty chemicals, agrochemical, additives, food additives, coloring agents, you name it, the entire gamut, they were all making tremendous amount of money. And if you look at the small chart in the middle, which I have shown here, that's actually the growth in the you know profitability of all the specialty chemicals. Look at the way they have actually moved, a tremendous movement upward. This showed you that they were all making money hand over fist. Now as you wound up further towards 2021, at the top 2021, the the usual thing happened. Everybody was having tremendous amount of business. China was not really showing any signs of going back to their older style. So everybody, every single big chemical company announced huge capex programs. Huge. I think some gigantic figure is the amount of capex that everybody announced. Each of them announced 3,000 crores, 5,000 crore capex, and uh, they wanted to build huge amount of capacities for what they anticipated as the continued surge in demand. Now all that came in. By that time, what happened is the raw material prices had all pushed up tremendously. Alongside, there was so much of export going on from India that container problem also happened. You people might remember reading about the shortage of containers. So shipping costs went up, raw material costs went up, and all of these people went into huge capex mode. The profitability was there, the money was coming in, profits were being made. But look at what happened to the price move. The price move began to stall, and the price move started to wilt slowly. And then later part of 2022, when the results started showing up, all of them continued to make money, but they were facing obscene margins of about 60% and more. And those started to whittle down, came down to 50 and 40 and 30, and maybe as low as 20%, etc., or maybe even lower. Now as the margins started to fall and the reality of inflation struck, and the combined if the combined effect of inflation and raw material costs began to erode margins, and when that reality struck, the prices of the chemical stocks have come down. So the cycle here seems to have peaked out. And once the cycle peaks, if you look at it from another technical parameter, which I've not mentioned here, but I'll mention it alongside, is that when any sector has been in play as the major sector of a bull market, that cycle does not repeat for the next two bull market cycles. So if you take an average length of a bull market as being about 4 years to 5 years, which means that the chemical sector, barring a few exceptions here and there, they will not be the leaders of the next bull market. There is a lot of news and there's a lot of expectation. Undoubtedly, SRF is touted as one of the best of the best. Vanity Organics, same issue, and so is everybody else. But then, if you look at history, and if you look at history of cycles, which falls under the ambit of also the ambit of technical analysis, you will find that the same sector is very rarely the leader in successive bull markets. You can take let's say the 99, 2095 to 2001 IT markets. And then the bull market till about 2008, 2010, you did not have recovery in IT majors. Stocks like Wipro and HCL Tech, they all dropped 90% from their peak values. The hallowed TCS fell about 60-65%. The same thing happened to metals back in the 90s. Tata Steel, Century, all of these cement units, the steel units, they all had their bull markets in 94, 95. It took another 10 years for them to really come back. So this is a well known and well documented thing. So a bit of a warning for the chemical buffs who may be in here. Numbers may be great, but we stand warned by history that they don't come. Okay, so let's move on to the next point. And this is something that I particularly want to highlight to investors because you all may be longer term investors, and there is many times lot of stocks which are value traps in the sense that they look great from the numbers perspective. So I have taken an example here of one of them. This is a Coal India chart. Now Coal India here is your earning per share, which has been going up very consistently, right? So you had 11 rupees 2018, 28, 27, 20, and again up 28 rupees 2022, and 45 rupees earning per share in 2023. So earnings have been going up very, very steadily. But the chart in the middle is a P ratio chart. Now you can look at the P ratio chart. It's actually been on a consistent downward move. And if you look at it at the bottom, that's a dividend yield chart, because Coal India slams you with a lot of dividends, right? And here on the top price chart, if you see, there is this marking, a series of markings here which tell you how many times it has given dividends. So you can see it's a very, very frequent dividend payer. So this is a dividend yield play rather than any kind of numbers play for a direction. But if you were to add in the factor of, let's say, technicals, then you will find that Coal India has been a consistently downtrending stock. And that has been for years together. This is from 2015 till now. This is 2023. So for 8 years, if you held Coal India, all you would have got is the dividend. And dividend, you would maximum get a yield of what? Okay, in the case of Coal India, you would get about 8-9%, which is a decent dividend for those, but no capital appreciation. In fact, capital depreciation, because the price of the stock would be down. So technical analysis, by marrying the trend to the fundamental aspect, will tell you whether you are actually planning to invest into a value trap stock. So there are many such names which are actually value traps and they don't really go up very much. So that is another reason for looking at technicals on an alongside basis. Okay, let's move on further and look at another stock which is giving us the best of both worlds, right? So now if you look at this, here is a stock. This is the chart of HAL. Now HAL is a recent darling of the market, right? Now you went to the early one. This is the one, yeah. This is harnessing the the best of both worlds, right? So when you harness the best of both worlds, now look at this chart here. I put in some numbers. These are the earnings of HAL 2019 through 2023. 69, 86, 97, 151, and 174. So the earnings have been on a tear, absolute tear, right? Now we saw that the earnings were on a tear for Coal India also, but then the stock never went anywhere. Now, if you look at the trends of HAL, Hindustan Aeronautics, you will find, and I have simply slapped on a simple moving average on this just to highlight the fact that the stock is into a trend. And then you will find that even a simple, this is a 25 period simple moving average. That's all that is there on this chart. And you can see that the trend has been very, very consistently up right into today. So that means Hindustan Aeronautics, despite the fact that the earnings have been going up, the P ratio has been going up, the market seems to be still in a mood to lap it up. So everybody is now talking about the big orders they are getting, etc. Okay, 80,000 crores of pending orders. It'll take them so many years to execute. So business is no problem. All this kind of dialogue you will hear. Now, unless this dialogue is being supported by the technical picture of a consistent uptrend, and for a consistent uptrend, you need a definer of an uptrend like a moving average, you need patterns on the chart, you need volumes to rise consistently, and you need some momentum to stay intact. So all of them are on the stage. When you create some you create a template like this, then you will be able to harness. And HAL has been a stock that we have been investing into and we have been trading into consistently. And it's a stock which, even till today, continues to make money for us. So, if you harness the best of both the worlds, then you will be able to reap a lot more return from the market, right? So, that was various points regarding the say the complementary nature. Now, let's move on to the next part of this whole presentation. If you look at the next part, what I've said here is, how do I make it a substitute, right? How does, now we have looked at the complementary side, now let us look at the substitution side. When will technical analysis act as a substitute for fundamental analysis? Now I've listed down a few conditions. The first one is, when you do not possess the skill to analyze using fundamental analysis elements. Now, not everybody can do fundamental analysis. People can do very, very skeletal level of fundamental analysis. If the skill is lacking, you will do a very poor level of fundamental analysis, and that will not work in the market, right? And when I say skill to analyze, what I really mean that you must be able to collect the data, right? And you must be able to interpret that data. You should be able to build correlations within the data, and you should be able to forecast what that data is saying. How many people can do this? Even those who supposedly do this MBA, finance, etc., I don't think they are in a position to do all this. Okay, second problem, when time availability is is an issue, that all this kind of collection of data, correlation building, forecasting, this takes a lot of time. When time is not available, then you need to have a faster approach, and that is the technical analysis, because you're dealing with only two variables, price and and volumes, right? Now, then the next one is, not not everybody is a 10-year investor. Not everybody is a 5-year investor. There are a lot of people who want returns for a shorter period of time. When you seek returns over a shorter period of time, technical analysis is what you will have to turn to, because fundamental is incapable of doing it over a shorter period of time. Okay, next is when markets are going down or undergoing consolidation. See, fundamentals tells you what is a good buy or what is a good exit, right? If markets are going down, there's no way to short using fundamentals. For using a shorting approach, you'll have to make use of technicals. What what about stocks which are undergoing consolidation? That is another um, style of market which will, where also only technicals will help you. So when market trends are down or undergoing consolidation, that is when technicals will really help. And when markets become extremely volatile, there are phases when the market is very volatile. Volatile markets are very difficult to read, and they keep changing. When the very word volatile means that changes are happening frequently. So this will be tracked only using technicals. Then, if you want to look at other asset classes, like you want to look at gold or silver or base metals or energy contracts or currencies, etc., technical analysis presents you with a single framework which you can apply across different asset classes, whereas the fundamentals relating to each asset classes are independent or interdependent perhaps, but definitely not the same framework can be applied to all of them. So here again, when you want to look beyond equities, technical analysis is the one to substitute fundamentals with. And finally, where technology is to be harnessed, I think that is another area where technical analysis will really excel, right? So these are areas where it will act as a substitute. Now, let me just give you some small examples of this. Let us go on to the next slide where I'm showing you something. Now, I am showing you a chart of a stock called TRIL. This is a stock called transformers and rectifiers. Maybe, maybe some of you would have heard of it, maybe some of you would not have. But then the fact is, if you look at the chart, look at the beautiful trend that this stock is seeing. Now, why have I chosen TRIL? Because there isn't too much of fact available about TRIL. If you try to research, you will not get any news about it. Periodically, something will come up. So, do you remember I said you must have the collection of data? Data availability should be there. You should be able to access it. You should be able to interpret it. When data availability is not there, charts provide you with an excellent substitute. Now, here I have used a certain template which tells me exactly when a stock like this, a relatively unknown stock or a less known stock, which you can look up the fundamentals of TRIL, you will find that it's a very steady performing company, no great shakes. It's about somewhere around 1300 crore market cap, and it is trading at about 32 P. So you'll say 32 P is very relatively expensive, but it is not expensive because it's in the same turf as, let's say, Siemens and ABB and all, and those are all trading at very high Ps. But then you will justify those high Ps because they are all big guns. TRIL is a small player, right? But still, their trends are rubbing off on TRIL, and my job is to make money. So I need to find stocks like this. We got into TRIL somewhere around 40, and today it is trading at about 100 rupees. Now that's a 2.5 time movement, and that has happened across the last about few months. That's it. It's not taken me five years for my stock to go from 40 to 100, and there is no sign that it is going to halt. If it is going to halt, my model will show me that it is going to do so, and I can take an evasive action. So when you do not have the necessary info about a stock, you may just receive a tip about something, but you can't find a damn thing about it. Look at the charts, get a good technical analyst to tell you what it means. Then you can, if you trust his judgment, you can definitely go ahead and buy the stock. I have one more such example for you, and this is a company called CCL Products. Now, CCL Products is into manufacture and export of growing and exporting coffee, right? So they have coffee seeds, coffee powder, etc., and they export to a lot of countries. And if you look at CCL, I have a similar picture. So what I'm showing you is a template where I just slap on this template onto various names where I feel that fundamentally it's a good company. Again, CCL, very steady performer, consistent gainer. It has a an ROE, ROCL somewhere around about 15% to 20%. It also pays dividend, no great shakes in any area. But look at the consistency. So we managed to get into CCL somewhere around 440, 450. The stock is currently trading at about 675 to 680, and it looks extremely promising for even a lot more movement from here. So I I would expect to remain firm in my investments with a stock like TRIL or CCL, and this is built upon largely upon my reading of the technicals of the stock rather than its fundamentals. I am going to keep track of the quarterly numbers, etc., to see whether there's anything going wrong, or if things continue to be steady and good, then I'll have no problem in holding on to this, right? So these are two examples which I have shown you. So now, winding down, let's go to the conclusion of what we have covered today. FA and TA exists to facilitate our working in the market and not a standalone analysis format, which is how they are thought of. You've got to stop doing that and look at it as something, as a tool which will come to our aid in our effort to make money. So combining the power of the two formats leads to some very, very positive synergy. That is what I have sought to show you today. And attention to FA changes lends greater meaning to TA signals. Please understand this. It does not mean that one, if you know technical analyst and it holds a little advantage, that doesn't mean that you be a purist technical analyst, because fundamental changes are what are the causes, as I said, and they will have an effect. And therefore, when it lends greater meaning to the technical signals on the charts, you can know what is the value of that signal rather than treat the signal just like any other, right? For shorter time frames, TA is the only route. And like I said before, risk control can be done effectively. And where FA details are not easily available, TA models can be used as a substitute. So these are the takeaways that I want to give you as a part of this small presentation. And here is a small idea of what I do, right? This is what I do in life. I have designed a model called the CGM model, which stands for Combined Growth and Momentum. Now, this is a combined fundamental plus technical model which I have created, which I use to invest and manage money of my own as well as my clients. Now, I have, sorry, this overshot. I have no interest in value picks. Let me make that very plain. Value picks demands that you have a lot of money, you have a lot of time, you have a lot of commitment, and you get consistent flow of news and information. I am not in the market for value picks. I have no interest in them. To invest, I am interested only in those stocks that pack a potential to go up, because you can only invest in stocks which are telling you that they will go up. If they are going to lie around there and they may be great quality, they may be substitute for gold, but still they are worthless if they don't go up. So I'm only interested in stocks that pack a potential to go up. And my technical study tells me when those stocks can go up. My fundamental study tells me how well they can do when they go up. And I practice a very active investment approach. I am not a long term investor. I don't sit back and wait for the market to give me money. I go out there and seek to make money. I'm happy to pay 15% short term capital gains tax. I don't want to be a long term capital gains tax by design, right? So, what I'm trying to say here is that I'm a professional active market participant. When I say that I'm a professional, I seek to make money from the market every month, every week, every quarter, every 6 months, every year, right? And my aim is to do about 30-35% CAGR in my investments, and to make anywhere between 5 to 10 odd percent per month in my trading. And this is what I seek to do. And by God's grace, He has been kind enough to allow me to do somewhere in and around this area. So this is what I do, so that you know where I'm coming from with all my views, right? So with that, I come to an end of my presentation. I thank you for a patient listening. If you have any questions, I would be happy to answer. And so take it away, Nilesh. If anybody needs to get in touch with me, these are my coordinates. Support at neotrader.in. That is our office support mail ID. You can reach us there. My staff is there. They will assist you with anything. I write frequently on my own website. It's called cknarayan.com. If you get a chance, do visit it. I post there daily views, script views, sector views, etc., all based on a technical standpoint. So I'm open for questions if there are any.
Thank you very much, sir. Actually, the last slide, I'm sure the investors. Can you hear me, sir?
Yeah, now I can hear you.
Yeah. So I told, I think the last slide is where the investors will be the most happiest, when you have talked about the returns you seek to get from your investments and your trading portfolios. And I'm
Yeah.
sure a lot of them are going to get in touch with you for that. Because that's really wonderful. And in fact, I'm so thankful to you that we came up with this idea, and you made a presentation which actually has answered all our questions. So we had
Great.
moderated, we had a set of so many questions which were there, and in fact through your backdated analysis which you did on equities, okay, on in all types of markets, where you gave analysis of specific stocks and the different scenarios where how technical and fundamental analysis either complemented or were substitutes. In fact, I think that's something which has made this this whole presentation very easy for investors to understand, in fact, because I think technical analysis is something which even I don't understand a lot, and it was very easy, through those examples for us to understand. There's no question from my side, because all the questions, in fact, which I had in mind to ask you, you have actually, elaborated and given it through the wonderful presentation. Over to you,
Thank you.
Angel, if there is anything from the audience.
No, sir. I must say that it was an extremely captivating session, though.
Okay.
And Dr. Narayan, we express our heartfelt gratitude for gracing this event. And on behalf of Cedrus Wealth Partners, we extend sincere thank you to you, sir. Additionally, we would like to extend our appreciation to all our viewers as well. And we move towards
Thank you
the
so
end.
much for everything.
Promise to return next month with all new topic and a new esteemed speaker. Thank you once again, all of you.
Thank you. And
Thank you for
Angel,
having me here.
yeah,
Thank you.
and for our viewers, if there are any questions which you have related to technical or fundamental analysis, do get in touch with us so that we can put you on to, you can ask questions to sir directly, and I'm sure he'll be happy to help all of you. In fact, thank you very much, sir, for spending your valuable time over a weekend, and I hope to, connect with you soon. Thank you.
Sure thing. Thanks for
Thank
having me. Bye
Thank you.
bye.
Bye. Bye, Angel. See you.
Bye, sir.